I'm Matt Bishar with NAREIT, and in conjunction with REIT Week 2020, I'm joined today by Pierre Rigaud, Vice President of Advisory and Consulting with Green Street Advisors. Pierre, I'd like to start by talking about the impacts of COVID-19 and how they're being felt throughout the global capital markets. Public REIT investors in particular are growing concerned over the potential long-term consequences that sheltering in place and general economic slowdown will have on the commercial real estate market. Can you comment on how public REIT investors have reacted to this pandemic, and more specifically, whether this growing concern is shared across the different real estate sectors?
Well, absolutely. Well, first and foremost, COVID is affecting businesses' ability to pay rent. And so what we've seen since the end of February really is the REIT market being down roughly 30%. S&P 500 in the meantime down roughly 15%. Now, there are wide implications by property sectors. Malls, lodging, healthcare down 40 to 50% on average. Apartment, office down roughly 30%. Industrial and self-storage not impacted that much. Towers, data centers actually up during the same time period. Now, the ultimate impact on property value in the long term should really be limited to short-term disruptions if there's not going to be any long-term change in behavior. And for example, a property losing all of its cash flow for 1 year, for 12 months, should technically have an impact to its value of about 5 to 6%. And so at Green Street, we've analyzed and quantified short-term disruptions in cash flow and potential long-term changes in behavior. And really one sector is standing out to us, defies any explanation that we have right now, and that's apartments. Apartment sector is down significantly, and we don't really foresee any long-term negative prospects in that sector. And the sharp decline cannot be explained by short-term disruption in cash flow alone.
While investors have a similar consensus on the short-term impacts and disruptions related to the pandemic, there's still plenty of speculation regarding the long-term implications of COVID-19. Which sectors, in your opinion, do you think are going to emerge as long-term winners as well as losers in a post-COVID-19 world?
Well, it's a good question. I agree with you. We are for sure going to see some long-term behavioral changes in some property sectors. And here really we see two buckets. One, industrial and retail. Now we're all familiar with that disruption. It's been going on for a number of years already. The increase in online retail demand has been a headwind for physical stores, and it's been a tailwind for industrial space. And really what we've seen during this pandemic is an acceleration of that trend. What it means for industrial, better short-term and long-term growth prospects. What it means for retail, well, what we thought could take 10 years, for example, the demise of lower quality malls, could actually be compressed and take only a few years. So that's retail and industrial. The other bucket is office, lodging, and the communication REITs. Now here, the adoption of potentially work from home policies, online meetings, online education, and so forth, could be a headwind for office and lodging. Businesses may not use these two property sectors as much as they used to be. That is a tailwind for the communication REITs, towers, and data centers. Online activity is likely to ramp up in the next few years and in the future, and businesses are likely going to shift more of their business online. That trend, though, is up for debate. It remains to be seen the type of policies that companies will be able to implement in the near term as far as work from home and moving some of their businesses online.
And finally, Pierre, public REITs typically exhibit more conservative balance sheets relative to the private real estate sector. Are certain REIT sectors more at risk than others given their debt levels in the current distressed environment? And moving forward, what should public REITs expect as they seek access to different sources of capital?
Well, the good news here, Matt, is that most equity REITs are in decent shape regarding leverage. It's true compared to how they were positioned back in 2007 during the last recession. It's also true compared to how they are positioned compared to most private real estate investment vehicles and companies who still use a pretty high amount of leverage. Now, a handful of REITs do use a very aggressive balance sheet, and they may get into some trouble. And there is going to be some more scrutiny to lend money in some sectors like lodging and retail. But overall, we see leverage as a non-issue in REIT world during this pandemic. And really, this is thanks to REIT executives over the last few years asking themselves, how much debt should I reasonably have, compared to many in the private sector asking themselves, how much debt can I possibly get? Now, good deals can be made during economic expansions, but great deals can be made during periods of disruptions like the one we live right now. And being able to play offense in times like this, it can reap huge benefits over the long term. And so compared to most private companies, we believe REITs are very well positioned right now to capitalize on these opportunities and potentially create outsized investment returns.
Pierre, thank you so much for joining us.
Thank you, Matt, for having me.
For more from REIT Week 2020, be sure to visit REIT.com.